Okay, so this is 2021 paper, question 3, financial accounting. So yesterday we ended on question 2. Today we're going to begin on question 3, moving forward. Yes, so as you can see the question, I've tried the best to highlight the questions so much that it's going to be clear, and I've already drawn the lines out here so much that we're going to be fast. Yes, so the question is right there. I've not started the question yet. We're going to be doing it together. Yes, so the question of the information in the trial balance there, and we have information at the adjustment. So under the adjustment we have our closing stock, which is never found in the trial balance, and also we have some other accruals and prepayments which we need to consider as well. So we can start the question now. So the first thing first, the question is asking us to prepare the income statement, which I've already prepared the statement of profit and loss, which is the lines I've drawn here, as well as the balance sheet on the I've drawn the lines on the other side. So let's start. So first things first, since we're preparing the income statement, we're going to start with our sales figure, and according to our question, our sales are 880,426. So for sales, you are supposed to take it in the last column if you don't have sales returns, but in our case there is a returns inwards, what we call sales returns, which means we have to do it from the middle column. So our sales figure is 880,426 less returns inwards or sales returns. Our sales returns inwards are 18,400. 18,400. So after we subtract, we're going to find our net sales. So we have 880,426 minus 18,400. So we have 862,026 as our net sales, or what we call turnover, net sales. So moving forward, we're going to the cost of sales, and cost of sales is not a direct figure we're supposed to calculate. So first thing under cost of sales is our opening stock, or rather inventory. So the type of inventory that we're talking under cost of sales is our opening inventory. So in our case, our opening inventory stock was at 30 April is 102,994. 102,994, and it has to go in the middle column. 102,994. Next, purchases. The purchase figure which goes in the mid column is our net purchases. So if there's any adjustment on purchases, we're supposed to do it from the first column, and the adjustment that are found on purchases are carried inwards, which are added, and also returns outwards, which are subtracted from purchases. In our case, we don't have returns outwards, which means we're going direct to add our carried inwards. So purchase figure, according to the question, purchase figure is 419,211. Purchase figure is 419,211. We're going to add our carriage inwards. Add carriage inwards. So our carriage inwards, according to the question, carriage inwards 1452. 1452. So we have 419,211 plus 1452, which is giving us 420,663. 420,663. This is our net purchases, which is supposed to go in the mid column, and that's what we have done. So our net purchases is that figure there. Coming next, we don't have anything that is added to the cost of sales unless we add cost of the opening stock that we found plus the net purchases figure that we have. So the 420 figure, which is the net purchase that we have, we're going to add the opening stock, which is on top. Doing that, we have a 523,657 as our cost of goods available for sale. Cost of goods available for sale. So the cost of sales figure that we need, we're supposed to subtract the closing stock before we take it in the last column as our cost of sales. So that's the next thing that we're going to do. So from the cost of goods that are available for sale figure that we've ascertained there, we're going to less closing inventory. So closing inventory, according to the question, closing inventory is the first adjustment there. Adjustment 1, it is 111,317. 111,317. So from the figure that we have there, if we subtract 111,317, we have 412,340. 412,340 as our cost of sales. Cost of sales, and since it's the cost of sales that we are working on here, we're going to subtract it direct from our net sales, so much that we're able to ascertain our gross of profit. So 412 minus, we are moving it from 862,026. We have our gross profit of 449,686 as our gross profit. 449,686 as our gross profit. Okay, that marks to the end of one of the important things we are doing in this table. Let's go now to find our net profit. So here now we're supposed to add our income stroke gains, but in our case, income stroke gains, anything that has received at the end, things like discount received, commission received, interest received, this was there, interest received, dividend received if it's there as well. But in this case, we don't have any of the things, which means that's all to do with our gross profit. And also there's provision for doubtful debts, which is found in the trial balance, and there's provision for doubtful debts, which is given at the end as an adjustment. So if any of those are there, we're supposed to compare what was the provision for doubtful debts in the trial balance and how much has it increased or decreased under the adjustment. So if it has increased, that increase is an expense. If it had decreased, that increase is supposed to be a gain, supposed to be added to the gross profit. But in our case, we don't have any provision for doubtful debts or allowance for receivables. We don't have any of those. If it was there, we're going to get the difference. Just if it has decreased, that decrease, the difference is going to be a gain. If it increased, the increase, just the difference is supposed to be an expense. So let's go to the expenses now. So for the expenses, the first expense that we have in the question is the 8% debenture, which is the interest on the loan which was acquired. But in our case, we're going to subtract, since this is a company account, we're going to subtract interest at the end of the question when we are done with all listing all the expenses. So coming down, the other expense that we have is a debenture interest. That one is talking about the interest that the company had to pay on the loan. Now the amount of money that they have paid already on the loan, which means money has gone. We don't need that here. Then next we have our wages and salaries as our first expense. Wages and salaries. So first you have wages and salaries. So wages and salaries figure, it is 123,289. 123,289. Next we have rent, business rates. So we have rent, business rates, and insurance. Rent, business rates, and the insurance. So I think this one is talking about the same thing, because rent is the amount of money that the business is paying for using maybe a building of another company or a building of a different person. Rates is talking about the amount of money that the business is paying for using the land of a different person. And insurance, if they insure that same land or that some building, which means that man is talking about rent. Yes, so rent, business rates, and insurance figure, we have according to the question, we have 16,240. We have 16,240, but there's an adjustment. Oh, you're making noise. Okay, so there's an adjustment on rent accrual. There's an accrual on rent, which means you're supposed to add that. So the figure for rent, business rates, and insurance was 16,240. But since there's an accrual, we're going to add, because accruals are added, then prepayments are subtracted in the income statement. So we're going to add our rent accrued of 802. So 16,240 plus 802, 16,240 plus 802, we have 17,042. Coming down, we have discount allowed, which doesn't have an adjustment. Discount allowed is 3,415. Then we have director's remuneration. Directors, okay, yes, it's there. Director's remuneration, and the figure is 82,400. Except there's an accrual as well. There's accrued rent in director's remuneration. So there's a add director's remuneration accrued. Or rather what we call due. So it was 6,000. We're going to add the 6,000 here. And if we add the 6,000, I think we'll have 00488. Yes. Okay. Next, we don't have any adjustment here except for depreciation. So moving on to depreciation, we have that of equipment as well as motor vehicle. So moving down to adjustment, they're saying depreciation on cost, that is depreciation to be treated on cost. So we have equipment should be 20% on cost, motor vehicle 25% on cost. So equipment, they're saying 20% is 20 over 100. That is equipment. So the cost of equipment itself was equipment that was 225,000. So 20% of that is 45,000 as our depreciation on equipment. Next, sorry, it's supposed to be here 45,000. Then next is motor vehicle. So motor vehicle, let me write it here in case. So 20% on 225,000. Okay, which is giving us that figure of taken there. Then next we have on motor vehicle. So motor vehicle, they're saying 25% on cost. So 25% times the cost of motor vehicle was 57,200. So this is 25% on 57,200, which is giving us 14,300. Okay, 14,300. Then I don't think we have any expenses here which we are supposed to consider. We only have little information in the table, so we are done with all the expenses. So if we add all the expenses, we'll be 14,300 plus 45,000 plus 88,400 plus 34,15 plus 17,042 plus 123,289. We have a 291,446 as our net expenses. 291,446 as our net expenses. Net expenses, which we are going to subtract from our gross profit. So our gross profit figure was 449,686. So we have 158,240. 158,240 is giving me a negative because I've started with the smallest number, which is down. I was supposed to start with a bigger number, which is on top. Okay, so that's why I've written it in a positive form. So that is the figure that was attained, which means this was supposed to be our net profit if there was no interest and other things coming in. So in our case, there's interest. This company decided to get a loan of how much was the debenture? The debenture was 40,000. The debenture itself was 40,000. Now they were supposed to pay a loan. That is 80% of that 40,000 is the interest which they were supposed to pay on the loan when repaying back the loan. So we have to calculate that figure. So we are going to list, this is our net profit before interest and the net profit before interest and tax. So less interest. So interest, they're saying 8% on the 40,000. So 8%, 8 divided by 100 times 40,000. We have 3,200 as our interest, and in our case we don't have any tax, which means the figure we're going to get when you subtract this net profit before interest and tax minus the interest is the net profit figure we're going to take in the trial balance. So the figure to have there minus 158,240. 158,240. We have 15,540. Our 15,540. Okay, this is our net profit after tax, after interest, in short, no problem, after interest. Then next step, this is the figure we are looking for. That's why we have to draw this table. But in our case, we still have adjustment which need to be worked on. We still have adjustment like adjustment 2. If you read through, we have dividend and things that are supposed to be dealt with here, and we also have another adjustment 6, but we're going to do, we're supposed to do it on a separate page where I was supposed to call that statement of changes in equity, but since we don't have enough information, we're going to do it from here. Then in the next question, in the next paper where there's a lot of information, we'll treat it as a separate entity, so much that we'll be able to see what is happening. Okay, so in our case, there's first of all, we should not forget retained earning, because this is the profit that was made in the previous year. So from this figure of ascertained, we're going to add our net profit from the previous year, which we call retained earning. So from this figure of ascertained, we're going to add our retained earning. So our retained earning, according to the question, retained earning, this is the profit and loss account as at 30 April. So that is our retained earning, which is 12,411. So from that figure, we're going to add 12,411. So from that figure, we're going to add 12,411. We have 167,451. 167,451. Okay. 167,451. From there, let's talk of transfer to reserves. Equity is made up of different components. We have asset valuation. This is when an asset increases value. Then we have income surplus, which is what we are doing here. Then there is reserves, or rather where the company decided to keep some money for future use. So that money is also equity, but now they have just decided to take it in a different form. So no wonder we call it statement of changes in equity, because it is just changing from one form to the other. So in our case, there's this last part, they're saying transfer to reserves, which means they are moving money from this income surplus, which we are preparing this now, to general reserves. So we're going to work on that. So there's transfer to reserves. So there's a transfer to reserves. So transfer to reserves, we have general reserve, which is having a 5,000, and fixed asset replacement reserve, which is having a 10,000. But I think since we don't have enough space, we can combine the two. So since we are just transferring money from this component to reserves, which means we are just going to subtract, this is income surplus, so we're going to subtract it from the income surplus. So since I said we're going to combine the two, it was a 10,000 plus a 5,000, which is going to give us a 15,000. We're subtracting. Next, dividends. I think this is where we need particular attention. On dividends, if you read through the question, they're saying the share capital consisted of 300 ordinary shares of 50 per share each, and 50,000 12% preference share of 1/4 each. The dividend on the preference shares was proposed to be paid, as well as dividend of 18% on the ordinary shares. So they're saying there was 300,000, which is ordinary shares, which was 50 each, and also 50,000 in which there was 12% preference share of 1 kwacha each. So they're saying on the preference share there's 12%. On the preference share there's 12%. So 12% of how much was the preference share? Preference share, they're saying it was 50,000. So times 50,000. So the dividend on the preference share is 6,000. The dividend there is 6,000. So 12% times 50,000, we have 6,000. That is the preference dividend. Then on the ordinary, they are saying the dividend on the preference share, which is the 12%, was proposed to be paid as well as the dividend of 18% on the ordinary shares. So 18% on the ordinary shares. 18% on the ordinary shares. Ordinary shares, going back in the question, ordinary share were 200,000. So times 200,000, we have 36,000. So for dividend, we have ordinary dividend, which is 36,000, and we have our preference, which was 12% of 50,000, which was 6,000. All these we are going to subtract them dividends because they are proposed, they have to be subtracted from net profit. So we're going to subtract them. So from the 167 figure that we have, 167,451, 167,451 minus 36,000 minus 6,000 of the net profit of, let me do it again. So we have it was 167 451 451 minus 15,000 minus 36,000 minus 6,000. We have, if I've not made any mistake, 167,451 minus 15,000 minus 36,000 minus 6,000. We have 110,451 110,451. Okay, we can now proceed. So we said we have 167,451 minus 15,000 minus 36,000 minus 6,000. We have 110,451 as our net profit. We end this one here. Straightforward, we'll go to the balance sheet, or rather what we call statement of financial position, and we have the lines drawn here as well. So we're going to continue from where we ended. Yes, so to the trial balance, to the when a statement of financial position, we know that the first things to appear are our non-current assets. So we're going to start with our non-current assets, and in our case we only have equipment and motor vehicle. Sorry, spelling is pretty poor, but that is equipment and motor vehicle. So equipment figure, if you remember very well, in the question it was 225. Equipment was 225,000, and the depreciation was 20%, which gave us the 45,000 plus the accumulated depreciation of equipment, which is this depreciation is found on the credit side in the trial balance. So plus 32,600. So we have a 77,600, and since we know that it is cost minus dip, first find the net book value, we're going to subtract it from the 225,000. So we have a 147,400 in there as the net book value, 147,400. Okay, then motor vehicle, we know that the value for motor vehicle is 57,200. Motor vehicle 57,200, 57,200. Then the depreciation was 25%, so times 25 times 25%, we have, sorry, motor vehicle, it was 25%, yes, 57,200, 25 divided by 100 times 57,200, we have 14,300 as our depreciation. Then plus the accumulated in the total balance, which is 18,200, 18,200. So we have a 32,500 in total, 32,500 in total. So the 2,500, we're going to subtract it from the 57,200 as well, which is going to give us a 24,700. Then we can close these two. We can find the totals of costs, which we don't have any use where we're going. So we're going direct to add the figure that we have is already in negative form. So I'm just going to subtract the 147,400 in order for me to find the sum without wasting time. So that is a 172,100 as our net current assets, net non-current assets. Then from there we're going to go to our current assets. In current assets, first things, we have our stock, and our stock value, the stock which goes in the tower in the balance sheet, is our closing stock, which was the 111,317 in this case, 111,317, our closing stock. Then debtors figure, debtors in our case, debtors, I think we don't have, okay, debtors is 227,219, debtors 227,219. Remember, debtors are supposed to be written in the first column, so much that we remove provision for doubtful debts. So we're supposed to write it in the first column, then less provision for doubtful debts, the one which is in the adjustment. But in our case, we don't have any provision for doubtful debts, so it will go direct like that. Then we go to money in the bank. Bank, according to our question, bank is 49,73. Then we have cash, since all on the debit side, which means these money are available. Then cash is a 62. So adding this, so we have 1,317 plus 227,219 plus 49,73 plus 62. So we have a 343,571. Then we are going to add it to our non-current assets, which is a 172,100. Doing that, we have a 515,671 as our net asset. Then we're going to the financed by part. So under equity, we have several components, just like I explained earlier. Equity, we have several components. We have retained earning, or what we call income surplus. Retained earning is the net profit that we are just from finding from the other side. So retained earning is our profit, which was 110,451. 110,451. So 110,451. Then we have our ordinary share, and going back in the question, our ordinary share were 200,000. So ordinary share, the first one on top, 200,000. Then from there we have those transfer to reserves. So they said transfer to reserve, they said 5,000, that is was general reserve, and fixed asset replacement was 10,000. So in the question, the fixed asset replacement reserve already was fixed asset replacement reserve. Fixed asset replacement reserve was 30,000, and they're adding in another 10,000. So it was a 30,000 plus 10,000, which is giving us a 40,000. 40,000. Then we go to the general reserves. General reserves figure was general reserves was a 15,000, and they're adding in transfer reserves of general reserves 5,000. So we had the 15 plus the 5, which is going to give us a 20,000. 20,000. So we have 110, 451 plus 200,000 plus 40,000 plus 20,000. This is 370, 451. 370, 451 as our equity part. Equity is made up of components, and these are the components that we have listed here. Then going forward, we have our current current liabilities. Current liabilities, the first liability that we can't forget is creditors. So creditors figure in the trial balance, creditors was 54,818. 54,818. Then from there we have accruals. We should not forget accruals. If we had prepayments, are supposed to come under current assets, but accruals current liability. So accruals we had two, we have 802 and 6,000. There is rent and the director's remuneration. So we can list the two. So there is rent, which was 802, and the director's remuneration, which was 6,000. In total, this is going to be 6,802. Okay, then from there we should not forget the interest. So like I said, there was 8% interest on the loan. So the 8% just on the 40,000 was a 3,200. But now there's interest which has been mentioned here. So the debenture interest, which is 1,600, which means from the 3,200 they paid a 1,600. What is remaining is an accrual which they haven't yet paid for. Remember, accrual is anything that they have not yet paid for. So it's an accrual. So we have interest accrued, which is 1,600. From there we have the dividends. Remember the dividends, they said these dividends were declared to be paid, were proposed to be paid, which means they have not yet paid for them. So it's an accrual as well. So the dividends. So dividends, remember the dividends we calculated, one was 36,000, the one that was subtracted from the net profit. Now since they are not paid, their accruals are supposed to be part of creditors as well. So the dividends, okay, dividends is ordinary 36 and the preference 6,000. Okay, ordinary 36 and preference 6,000. So we have dividends 36 and 6,000. That is going to give us a total of what? So that we do it at once. So it was a 36,000 plus 6,000, which is going to give us a total of 6,000. That is a 42, 42,000. 6,000 plus 36,000, we have 42,000. So we're going to add the 42,000 that you already have plus 1,600 plus 6802 plus 54,818, which is giving us a 105 to 20. 105 to 20. Then we go to non-current liabilities. That is the long-term loans, if they are there. Non-current liabilities, we have the bank loan, or what you call the debenture itself. Debenture, which was a 40,000. So the figure we have plus a 40,000, we have a 145 to 20. 145 to 20. 145 to 20. We add it to the equity. Remember, it is asset is equal to plus liability. So equity is this plus liability. So we're adding it to the 370, 451, which is giving us a 515, 671. 515, 671, which means it has balanced. So we are done with the first part. We go to the next question. So coming next we have Statement of loss. This is a cash flow statement. So we're going to the cash flow statement. This is our question 4. Okay, cash flow statement question 4. Okay, so that's all. In case there's any part you're not clear, you just screenshot or pause, then you can come back to me. Okay, so we're going to the cash flow statement. So this is our question 4. So they're saying the summarized statement of profit and loss for the year Shanshanoko, and the statement of financial position as at Shanshanoko. So we've been given 2 comparative years. We have a 2020 and a 2019, in which we are talking about the movement of cash. So in our case, we had the cash of 53. At the end, we don't have, okay, let me say at start we had the cash of 0 kwacha, but at the end we're arriving at the cash of 53. Where is this money coming from? That's what we're working on. We're talking about the movement of cash. So here, don't forget there's a bank overdraft, so which means at the start we had an overdraft of 84. How are we arriving at 53 kwacha? Which means we're going to look for at start there's, so bank have a 53 minus, it is closing minus opening. So 53 minus opening, or opening was negative 84. So it was an overdraft, it's going to be negative 84, which is the overdraft. So we have 137. Where is this 137 coming from? If we had at the start we had an overdraft, we didn't have any cash. If you check here, we don't have any cash in the bank. There's nothing. This is the total of these two. But at the end we have the cash of 53. So which means at the start we had an overdraft of 84. How are we arriving at 53? Where is this 137 coming from, which has covered the 84 overdraft that we had and giving us a change of 53? Where is it coming from? That's the thing that we're going to work on. So I've already drawn the tables, so which means we're going direct into the question. So first things first, we're going to our operating activities. Under operating activities, first thing to appear is our profit before tax. So in some questions, you are given 2 comparative years. In other questions, you'll just be given the current year, or let me say the year in which everything was being calculated for the income statement. So in our case, we've been given 2 years, which means we don't need any information from the previous year. In this case, we have 2019 and 2020, which means we don't need any information from the income statement of 2019. We don't need anything. So let's go to our 2020 information. So we said we were looking for the profit before interest and tax. So the profit before tax in this case is 403. So that's what we're going to write, 403. And then we're going to look for everything that is between the operating profit, what we call profit before interest and tax, and the profit before tax. Anything that is between that. So in our case, our operating profit, let me say profit before interest tax, it is 2578, and the profit before tax is 403. Between, there's only an interest of 65, because the 468 on top is a total. So there's just an interest of 65, which means that's the only thing that we have. If we had a lot of things between those, we're supposed to bring them. If this one was added, we subtract. If this was subtracted, we add it back. But in our case, we only have interest, which was subtracted, which means that's the only thing that is going to come here. So interest of 65. Remember, we don't need any information from the 2019 table. Okay, so interest. Next, we need our depreciation here. And to calculate depreciation, I said, okay, I think this is the side that we're going to use for our calculations. So for depreciation, we said, so remember we're looking to find 137. Where is this 137 coming from? If you had an overdraft of 84 to start, where are we getting the 53 kwacha at the end of the financial period? Where is the 137 kwacha coming from? That is covering our overdraft and giving us a change of 53. Okay, so with depreciation, in the question we have been given depreciation details, which means at start we had depreciation of 2018. At the end you have this one. If you didn't have any information of any item which was sold, which means that information is enough for us. That difference is the only thing that we needed for depreciation. If it was appearing anywhere here, we are going to get a figure direct. But in our case, we have some items which were sold. If you can read through the question, they're saying equipment that had cost the company 240 was sold in February 2020 for a loss of 12,000. The net book value of the equipment when sold was 96,000. So